Welcome everyone to the Jasper Mortgage Group New Realtor 101 training for all about mortgages. So I hope that you leave this training understanding enough about mortgages to be dangerous, empowering you to sell more real estate because you feel confident talking about what clients' options are. If they don't qualify for one type of mortgage, what else is out there to enable a purchase? Also, how do mortgage rates move? Why do rates move? What are they based on? All these things are really important when you're selling real estate. So I hope this is a good, quick summary of all of those topics. Just to introduce myself, my name is Christina Jasper. I'm a mechanical engineer by training, so I'm a huge nerd who loves numbers. And after doing design engineering for about 10 years, I transitioned into financial planning. After financial planning, I went into mortgages, and I really feel like talking to people about their full financial picture, the way a financial planner would, helps us empower clients with knowledge. Most lenders come in and say, hey, client, this is how much you are approved up to, which is your 50% debt to income ratio. That should be incredibly uncomfortable payment for clients. So instead of saying this is what you're approved up to, our team's goal is to figure out what a client is comfortable spending. And when they feel super comfortable about what price point that they're in, they're more likely to buy and buy faster. So that is the benefit of using our team. All of our LOs are trained in that financial planning model. And that is the end of the sales pitch, though. The rest of this training is all education. And let's start off that education with lender types, because not all lenders are created equal. We're going to start with the most popular kind, which is the online lenders. They're the most in your face with advertising. So speaking of advertising, there's nothing that makes me personally more nauseous than when I see Rocket Mortgage on a Super Bowl ad with a client walking around a house, an open house, with their cell phone, and they type a couple things into their cell phone, and all of a sudden spits out a pre-approval in minutes. And they act like that is a huge benefit. Get pre-approved in minutes from your phone. Guys, that is the riskiest pre-approval out there. Pre-approval letters that take minutes are as strong as the paper they are printed on. Just because someone has a pre-approval or pre-qualification does not mean they're truly approved. I was just talking to a nurse the other day. Nurses traditionally have fluctuating income. She said, hey, I'm guaranteed 36 hours a week and this is my hourly pay. So let's just say that came out to about $75,000 a year. Great, she would easily be approved for what she was looking for with that income. But once I got her pay stubs and did the legwork to figure out if she's truly pre-approved for that mortgage, I found out that she did not actually work 36 hours a week. She fluctuated significantly, averaged out to about 24 hours a week. That dropped her income enough where she would no longer be approved for the price point that we were originally talking about. If she had gone to an online lender or a bank where the loan officers do not typically check your income, you can get a pre-approval, and then they get into underwriting, and the underwriting team really sees what's going on. That pre-approval is no longer good. It's based on what you said, not truly what's there. So working with a loan officer who actually checks that documentation and does those calculations up front is what creates a really strong pre-approval so that people's deposits are not at risk. Banks are similar in that way. Loan officers are typically, they're salaried. It's not commission based, which does make a difference. It does not line up their goals with your clients. If I'm going to make $100,000 a year, no matter what I do, volume wise, I care a little bit less about whether or not a client gets to closing on time and beautifully. Especially if people are just walking into my front door to ask for pre-approvals. I could sling pre-approvals all day if the people who walk into my office ask for pre-approvals. Brokers and correspondent lenders are much more of a relationship-driven business, meaning that we get our referrals from realtors, from past clients. It's a relationship business. If we do not close on time and beautifully, we stop getting referrals from those referral sources, right? But the difference between a broker and a correspondent lender, you might be able to tell which one I prefer by the pictures. So that Wonder Woman at the bottom shows you that I am a correspondent lender and I believe in this model for one big reason. I have control of this mortgage from the second you refer a client to me all the way through closing day. Brokers hand off the loan to whatever bank they're brokering to when they lock the interest rate. They lock with the bank and then turn it over to that bank to underwrite the loan. Correspondent lenders, underwriters are in-house. I know exactly who's underwriting that loan. I can ask them questions, rattle the cage if things are going slowly. I'm a control freak, and that control is important to me. And it should also be important to you. So if you're working with a loan officer, ask them, what are they? What is their model? Are they a broker? Are they a correspondent lender? Understand that model, because that model is going to affect your clients if things go sideways between contract and close with how much control they have over that loan. So now let's talk about different loan types. Of course, there are more loans out there than this, but I'm going to just cover the ones that are the most common. We have conventional loans. Conventional loans are those vanilla Fannie Freddie loans. Conventional loans you can do as low as 3% down for a first-time home buyer, or 5% down for anybody who's bought their second home, third home, fourth home. I'm really surprised how few of my clients and realtors know that it can go as low as 5% down if they bought a house before. You absolutely can. You have to take on mortgage insurance if you do that. Mortgage insurance is what you pay when you put less than 20% down. But for someone with good credit and a good debt to income ratio, that mortgage insurance could be less than $100 a month. It might not be a very big deal. So I always encourage clients to look at more than just, can I put 20% down? Because that penalty for doing 5% down frees up a ton of cash. There's an opportunity cost with that cash. You can invest it. You could do some fun stuff with it, buy some furniture. So are you willing to take on that little bit of extra penalty in mortgage insurance to do less than 20% down? Government loans are things like VA, FHA, USDA. I would argue that VA loans have easier underwriting guidelines than conventional loans. It is easier for me to get a loan for a veteran than someone who is not a veteran, because the VA is in the business of trying to get veterans in homes. They are passionate about it. They want it. That means if there's any gray area in a VA loan underwriting guidelines, which there's a lot of gray area, I can bring a client who would not typically qualify for a conventional loan. And if they're a veteran, I can make a really good case for that veteran of why they can repay this mortgage and they're a strong buyer. And as long as the VA agrees, they can buy a home. Same with appraisal. When we do an appraisal on a government loan, specifically VA, this is not for FHA, but there's something called Tidewater that if that appraisal comes in lower than what is expected, we can start Tidewater. And what that term is for is a super cool term for, hey, appraiser, here is the proof and evidence of why we believe this appraisal should be higher. The appraiser looks at it. If they dig in and say, no, I'm not upping this appraised value, but we truly believe that value is higher, we can then go to the VA directly and say, hey, I'm sure this appraiser is a great appraiser, but we still don't agree with what they're saying. VA, will you look at the comps that we pulled and tell us whether or not you can bring up the value? I have seen this work quite often. When I've gone back to try to get conventional loan appraisals increased, it seems a little bit harder. We have a great group of appraisers. We use something called an appraisal pool, which is I have hand-selected appraisers that are really good in this market. It's still a random selection of appraisers that we use, but it is still from this pool of really great appraisers. Kind of going back, I apologize to banks and to brokers. That is a big negative on their part. They use something called an appraisal management company, which is thousands of appraisers in a system. Cheapest one wins. So again, that broker losing control of the loan, the bank not having, or that bank loan officer having less control of the loan, that is a part of it. Now, one thing about government loans is there are going to be some additional requirements on our appraisers when they go out there to determine whether or not the home can get a government loan based on hazards. I have a whole entire list of FHA hazards that appraisers are looking for that are not things that we would typically look at a conventional loan. please reach out to me if you want that list. We can absolutely send it to you. Jumbo loans are loans that are higher than the annual jumbo or conventional loan limit. You can look up the conventional loan limit. Type in the year, conventional loan limit, and it'll tell you. In 2024, that limit was around $764,000. And any loan above that, not purchase price, any loan amount above that was considered a jumbo loan. Those jumbo loans have additional overlays that make it a little bit harder to get a loan done. So we really have to be careful on whether or not the client qualifies for the jumbo loan. And also jumbo loans, there's a big benefit to putting 15% down or more. So they don't have those beautiful 5% down options that conventional loans do without massive penalties and interest rate. Non-qualified mortgages or non-QM loans are for clients who do not qualify for the first three things we talked about. They don't qualify for conventional. They don't qualify for government. They don't qualify for jumbo. There could be a unique loan route called non-qualified mortgage that they could qualify for. Really good example of this. You have a client who is a self-employed borrower who gets paid a heck of a lot of money in cash under the table. It never hit tax returns, but we have a bank statement loan where we can get the bank statements from the borrowers and really prove out their true income that doesn't show up on tax returns to get them qualified for a mortgage. Now, non-QM loans know they're doing you a favor. They know that you came to them because you could not qualify conventionally, so of course they are going to penalize you a little bit on the interest rate. So we would just have to look at that and just be very transparent with our clients like, hey, we can absolutely get you into a house. The second you qualify for a conventional loan, we can refinance you into conventional. But right now, the way we're going to enable you to buy a property that you love today is by using this non-QM loan route. So if you have somebody who did not qualify with a bank or another lender that you're working with, still send them to us because we can probably find a route to qualify them. There are first-time homebuyer programs out there, but I do warn people that there is no such thing as a free lunch. Most of the time, they're tied to adjustable rate mortgages. We're going to be talking a little bit about why I don't recommend adjustable rate mortgages right now. They are typically loans, not grants. So there's just a lot of fine print associated with them. I'm not saying we don't do them. We still do them. I recently did a North Carolina housing first-time homebuyer program, which is a $15,000 loan. No interest loan. Explain to the client all the downsides of it. For example, you cannot refinance them. That $15,000 loan is attached to that specific mortgage product. So the rate that you get is the rate you have. If you go to refinance it 5 years down the road, you have to pay back that $15,000. So there is fine print. Sounds fantastic. But we'll work with those first-time home buyers to let them know what's the best product for them and the best first-time home buyer product for them. The last thing I get asked about a ton is bridge loans. So I have a client who, doesn't want to sell their house first. We need a bridge loan. Yes, there are bridge loans out there, but I like to find other avenues to find money first before going down the bridge loan path. I do have banks that I refer to for bridge loans if these avenues don't work out. But let's go down those avenues first to figure out how we can piece together a down payment without doing a bridge loan. So here are some creative down payment strategies in order of preference. So, number 1, gift. You'd be surprised how many people I talk to who are like, oh, Christina, I don't have enough money to put down. I need to sell my house first. I'm like, great. They're like, oh, do you have a bridge loan? And we start going down this path and I say, hey, do you have any friends or family that could, for example, lend you or gift you? I'm not going to say lend you because in the lending industry, it's not a loan, it's a gift. Someone who's willing to give you money for a down payment. And they're like, oh my gosh, yeah, I bet you my parents would throw me, $50,000. And so I do have to bring this up sometimes for people to realize it's even an option. The second on the list, because not everybody has parents that come out of the woodwork throwing money at them, right? So your second option is a 401k loan. 401k loans, not withdraw, 401k loan is beautiful. It can be done against only an active 401k account. So we can't use a past employer's 401k. But if you've been working at a job for a few years, you can get as much as $50,000 or half the balance, whichever's lower, but you're the bank. When you pay back this loan and pay interest on it, the interest goes into your 401k account. You're saving for retirement while borrowing money from yourself. We do not have to count a loan payment against you. So this is why I love them. If you were to borrow $50,000 from a 401k, and remember, sometimes there's two borrowers, a married couple, they could both have $50,000 available to them. That's $100,000 of down payment availability. And then when they sell their home, they can pay it off, right? But because you're the bank and you're paying yourself back, I don't have to count a payment against you. So it doesn't hurt your qualification for a mortgage. Same thing with a margin loan. Margin loan is exactly like a 401k loan, but instead of borrowing against a 401k, you're borrowing against stock. So older clients, this is beautiful for them. They've saved a ton of money in stock. Go back to their financial advisor and say, hey, how much can I borrow from a margin loan temporarily? You're going to pay it off quickly. Now, you're not the bank here. The interest doesn't go to you. The interest goes to the bank, but it does not create a payment for us because there's no required payment on a margin loan. They're going to withdraw some money from your stocks if you can't pay it back. So it does not hurt you for qualifying. Again, beautiful. My fourth favorite is an IRA withdrawal. Huge risk here, even though it's, there's still one that is below the IRA withdrawal, the HELOC. We'll talk about that in a second. But IRAs, you can draw money for 60 days. As long as you replace it within 60 days, it's like it never happened. So if your client is 100% sure that they can sell their home in 60 days and replace this money, I only really like this if you have a strong plan B. So if you have that client who's like, I can ask for a gift from my parents, I would prefer not to. I would say, hey, what if you did an IRA withdrawal and have your parents be your like Armageddon plan C, that if you cannot repay your IRA in time from the sale of your home, they can be a bridge for you. They can put money into your IRA and then you can repay them after you sell your home. So that's the IRA withdrawal. The reason why HELOC is last, even though it seems like a super simple thing for someone to do, to pull out money to put a down payment on the next home before they sell, it does create a payment that counts against their debt to income ratio, which makes it harder for them to qualify for the mortgage for the home they're buying. So before you recommend to a client to open up a home equity line of credit against their house for down payment, please make sure they talk to the lender to make sure that they qualify for a mortgage, paying their existing mortgage, and paying a new payment on this new HELOC all together. If they qualify for all of those three things combined, then yes, they could do a HELOC, and that's a really great way to get money. They take about 3 weeks to open, so we just have to be conscious of that. It's not something we could do in a rush, but a great way to get money if you qualify to do it. Send them to me before you recommend that they do. Now let's talk about assumable loans. Assumable loans are popular right now when we're advertising for properties that have government loans on them. VA, FHA, USDA, all assumable loans. So if someone is running around with a 2.5% FHA loan and it says, hey, your buyer can assume this loan. Sounds super exciting, right? But one does not simply assume, because the buyer has to be able to come with a down payment that is the difference between the purchase price and the loan amount. So if this loan amount is $100,000 and this person bought the home 3 years ago for $300,000, it's now worth $600,000. That person has to come with $500,000 in cash to cover the difference between the loan amount and the purchase price. Not many people can run around with that much money. Now, older clients, maybe they do have a lot saved. They're willing to do that kind of down payment just so that they can have a loan with low interest rates. They don't have to buy in cash. But just know that you cannot just simply assume an assumable loan. Now let's talk about how I could help you negotiate like a boss. Whenever we think about a house that's been sitting on the market and we're trying to get our buyers the best deal possible, I always feel like that knee-jerk reaction is to do a purchase price reduction. So let's say, a house is worth $500,000 and you think you can get $490,000 for your clients. You get $10,000 off. You feel like a rock star, right? Like, woo, I got $10,000 off for my clients. But is there better ways to use that money? So we're going to deep dive into that with using seller credit for a purchase price reduction, seller credit towards closing costs, bringing down someone's cash to close, or a seller credit towards interest rate. And this can either be a permanent interest rate buy down, permanently buying down the rate for your client, or a temporary one where you can buy down a rate 2% the first year, 1% the second year, and getting the rate up today for, the third year forward. I don't recommend this for every client because there are a chance rates might not go down. And we're going to be covering that in the interest rate portion of this presentation. Why do I think rates right now are really good rates? So if you do a temporary buy down and rates don't come down, how disappointed are they when they're stuck with today's rate, and how comfortable are they? They have to be comfortable with the payment of today for us to do that. The last is something completely different. It's lender credit. I love lender credit, especially when the seller is not paying 100% of your buyer's agent commission and the buyer's really strapped on cash and they're hoping that they don't have to pay it either. Who else can pay it? The lender. And the way we do that is we are going to wrap it into the interest rate or finance it in the interest rate. So if the free interest rate today, I'm just going to use round numbers here. Let's say the free interest rate today was 6.5. If I went up to 7%, instead of someone paying points and going lower, they could do the opposite of points and go higher, and I can give a lender credit towards closing costs. And guess what? Your realtor fees are part of closing costs. So I can cover a portion of that. Let's take a closer look. So we have a $10,000 price reduction in the first column. And if a client's putting 5% down, their all-in payment, taxes, insurance, mortgage insurance, principal and interest, all in for this specific client was about $3,589. Now, is there better ways to do a $10,000 price reduction? Instead of taking it off the price, what if we put it towards closing costs? So in the first example, the client was bringing $35,000 to closing, but if you have a client who's really cash strapped, bringing an additional $10,000 to closing is a big deal. But if we can have the seller pay their closing costs, and now they're only bringing $25,000 to closing, that could be really huge for them. Their payment only went up by $62 a month doing this. That's it. So for every $10,000 movement, whether that be a price reduction, $10,000 towards down payment, $10,000, towards closing costs. So, that purchase price went up by $10,000. All of those $10,000 movements is only $60 a month. That's really good to know for negotiation. So if you have a client who's at a sticking point and you're in a competitive offer situation, they're buying a house for $500,000, they have to go up to $510,000 to win the deal. Remind them it's only $60 a month. That's it. So just a really good thing to remember when helping your clients negotiate. Well, what if they're not cash strapped? What if, going down to $25,000 is not a big deal to them? They don't mind bringing $35,000 to closing. So instead of putting $10,000 to a purchase price reduction, the third column is a permanent interest rate buy down with $10,000. Now, based on this client profile and rates that day, we could buy an interest rate of 5.75 with $10,000. Now, even though the purchase price is $10,000 more, $500,000 at list price, we have saved our clients $168 a month by doing money towards points instead of money off purchase price. That's a huge savings for someone cash flow wise. So if you have someone that feels a little tight or they want to save a lot of money, and in my coming slides, I'm going to make an argument that 5.75 could be a permanent interest rate for them. They may never refinance at that interest rate again. History tells us that this is a really low interest rate. So you're also saving your clients potential future refinance costs going this route. Now, if the client has even more cash than $35,000, they can buy this rate down even more with their own monies, but this is just using the seller's money. So that was just 3 ways to use seller credit towards interest rate buy down. Now let's dive into this fourth column. This is a lender credit towards agent commission. So the reason why I didn't do $10,000 lender credit towards agent commission is because we will cap out somewhere on lender credit depending on what rates are on our rate sheet. So let's say the highest rate on my rate sheet is 7.125 and it's giving a credit of $7,500. That's going to limit me, right? Like this is where I stop. If I don't have a rate on the rate sheet of 8% giving $15,000, I can't give it. But we do have rates on our interest rate spreadsheets that give lender credit. Interest rates are kind of like a seesaw. The free rate's at the center. If you go lower than the free rate, you pay points. If you go higher than the free rate, you get a lender credit. And you can apply this lender credit to closing costs. You don't have to put it towards agent commission, but this is a really beautiful thing to do if a client is having a hard time coming up with the money to pay you. They can finance it into their interest rate, go to a higher interest rate, get whatever lender credit is available for that interest rate, and put it towards closing costs or your agent commission. Now, in this specific scenario, 7.125 was paying $7,500, which created an additional payment of $260 a month. What I love about this option for clients is, yes, they're at 7.125, but they will likely have a refinance opportunity in 6 to 8 months to bring this interest rate down. And if they do that, they might not have paid more than $7,500 by the time they refinance. So I have given them more money than they'll ever give me. They win, right? If you get $7,500 cash in hand to put towards a cost, and then you refinance and let's just say 10 months, you've only paid me an additional $2,600 and I gave you $7,500. But the risk is, what if rates went up, which history tells us they could? What if rates went up in a way that we can't refinance this 7.125? We always have to make sure the client is comfortable with that $3,850 payment before getting them into this scenario. But as long as they're comfortable, this is a beautiful way for buyers to pay agent commission. So now, let's talk about rate and why I truly believe that 5.75 is a beautiful rate historically, and why there's a chance that we will not refinance a 7.125. Got to look at history, right? This is historical interest rates from 1970 on. This really thick gray bar here, 2008 to 2010, that was the mortgage crisis, right? From this gray bar on, the federal government were falsely holding mortgage rates down. And the way they do that is buying mortgage bonds. The Fed funds rate has nothing to do with mortgage rates. When the Feds cut the Fed funds rate, mortgage rates do not go down. They're not correlated in that way. Fed funds rate controls short-term lending, car loans, credit cards, home equity lines of credit. When the Fed cuts the Fed funds rate, those go down, but mortgage rates don't. There's a Fed cut in September of 2024, and the day after the Fed cut happened, mortgage rates went up, because we are based on the mortgage bond market. The way the Feds can control mortgage rates is by purchasing mortgage bonds. The sexier mortgage bonds are, the lower mortgage rates are. I can buy a mortgage bond. You can buy a mortgage bond. The Feds can buy a mortgage bond. And so that's how the Feds control mortgage rates. This huge leap that you see right here, that is when the Feds just wiped their hands clean of mortgage bonds. They said, we're not buying mortgage bonds anymore. They've been buying them since 2010. They went hog wild during COVID. That's what pushed the mortgage bonds down so low, which created super low mortgage rates. So if the Feds are no longer supporting us, we are in a market climate that was prior to 2008. This is a non-Fed supported interest rate market. We kissed very, very short period of time, 5.875 in the early 2000s. Kissed it, didn't live there, kissed it. We really lived between 6% and 8% for over a decade in a non-supported market. Now, prior to that time is that, the big outlier of the 1980s when inflation was through the roof, mortgage rates went through the roof. But if you really look at a normal market, not the outliers, God, even a low 6% interest rate is a beautiful interest rate, historically speaking. If the Feds don't step back in and buy mortgage bonds, I don't think we're going to see the low fives again. And they've said that they're not going to do that. So, never say never. Maybe they will. But this is why I believe mortgage rates in the high fives or low sixes are really beautiful, and why I also believe that there is that chance that rates could get up into the high sevens and eights, and you will not refinance a 7.125 again in the future. We don't know. None of us knows. Our crystal balls are very broken. But Since we were talking about mortgage bonds, this is a picture of the mortgage bond market. I'm not showing you this to confuse you. I'm showing you this to show you how volatile the mortgage bond market is. Right now, up is good, down is bad. So it's an inverse relationship. So when you see this chart, these going up, mortgage rates are dropping. Every one of these little candlesticks, this is called a candlestick chart. Every one of these little candlesticks is one day in the bond market. So where we get big candlesticks. For example, the very first candlestick on this chart was April 10th of 2024. The rate that I quoted in the morning was 1/4 to 0.5% different than the rate in the afternoon. That's how much rates can fluctuate even in a day. But I just want you to make you aware of that because, our best guess is rates today. And so when we talk to clients about what they can afford, I warn them, we're basing this on rates today. They could change. So let's just check in quite often to make sure that your price range is still based on the rates in the moment. The last thing I want to show you, again, I don't want you to glaze over, just really quickly. This is what I see behind the scenes. The day that I pulled rates, I see a full spectrum of interest rates moving in 1/8% increments. The middle column here is the principal and interest payment for each one of these interest rates. And the last column shows me points. So you can buy whatever rate you want. I tell people that this is a choose your own adventure. You can go as low as you want, but just know that you or the seller will have to pay for it. So the dollar amount that you see on the far right column represents the cost of the points. 1 point's 1% of a loan amount. So this is just a certain percentage of the loan amount used for showing you this exercise. But then there's a tipping point where the positive number becomes a negative number. And that's the lender credit. This is how I can give people credit towards their closing costs. So now let's talk a little bit about the lender relationship. So what's the best way for you to work with your lender? The easiest way that you can work with us is introduce your clients by group text to our team text line. We find clients respond faster. We get pre-approvals done faster, which means clients are out shopping faster if we are introduced by text. So it's a really huge benefit to introduce by text. We then hand back the client with a huge amount of goals. Not just home buying goals, they're general life goals. You'll be surprised how much someone's financial overall goals will change what they want to do with their mortgage once we identify them. I have clients who have talked about doing 20% down. They had more than enough cash to do it. I say, yeah, 20% down sounds great. Tell me about some other goals you have other than buying a house today. And they might say, you know what, in the next 5 years, I want to buy a rental property. Oh, and by the way, we have family that lives overseas. And we want to buy a property overseas for them. Now, all of a sudden, that 20% down that we originally talked about doesn't sound like a great plan anymore because it's a primary residence. You can do 5% down. Why don't we hold that cash for that investment property purchase? So things shift a lot when we start looking at that bigger financial picture. After they go under contract, the things that we really care about from you, we want the contract and all the addendum that go with it. If there are any addendum changes, any new ones, or closing date changes or seller credit changes, let us know as soon as possible. There's nothing I love more, and I'm being sarcastic, there's nothing I love more than my attorney telling me that the close date changed or that there's this big seller credit the day before closing when it happened weeks ago. So please always be transparent with us on changes that are happening during the process. And also, please be aware that there are seller credit limits. So when you're asking for seller concessions on a contract, you are limited depending on the client's down payment amount. I have a really great cheat sheet for this. Just let me know if you want it. And that cheat sheet will show you if a client's putting 5% down, you can get a 3% seller credit, 3% of the purchase price. If they're doing 10% down or more, it's 6%, but it also depends on the type of loan. So make sure you use that cheat sheet before putting the seller concession so you're not asking for too much in concession. Also, there's a reason why lenders divorce homes. If you have a client who put a big deposit down, please be aware when you're doing your walkthroughs that roofs and foundations are two things that we care a heck of a lot about. When you're walking through the home, look up. Make sure there's no water stains on the ceiling. If there is, we're going to want confirmation that that roof is not leaking. We want a fully functional roof when we buy a home with a client. Same with foundations. Look for cracks. Look for soft floors. If floors feel soft in a certain area, that usually shows us that there's some foundation issues. Uneven floors. And also those cracks, not just in the foundation, but the interior walls. If our appraiser points out any of these things to us, we're going to want a structural engineer to come in and give the full go-ahead and okay that this house is structurally sound. If it's not, those issues need to be addressed prior to closing. We cannot do escrow holdback for major repairs like that. Also, be aware that high DDR8 repair costs and high dollar vendor checks create a red flag for lenders. Our underwriters do see the seller alta. If we see a $25,000 check going to a plumber, we know that there's a huge plumbing issue in that house. We don't want to buy that house with that big plumbing issue until it is fixed. Now, if you have a $25,000 check towards something aesthetic, like a porch or something, a full house paint job, great. That will fly as long as we can tell the story that the thing that we're writing that check for is aesthetic, not something that is a true repair. Also, no matter what kind of loan you do, they all care about safety issues. I had a house at the beach that had one of those little widow walk towers, and the top of the platform, the top of the stairs, the little spiral staircase that went up, did not have a railing at the very top. I could literally step off that platform and plummet. We needed a railing put on before closing. That's a safety issue. If there is glass that is cracked, I know it's not fully broken and jagged, but someone can still cut themselves on cracked glass. So we need that repaired prior to closing. These are safety issues. And I mean, FHA government loans really care about more safety issues like peeling paint that conventional loans don't care about. But all loans do care about things that someone could be harmed. And we want those repaired prior to closing. So now it's your turn. Hopefully I covered everything to make you dangerous to get out there to sell real estate. But if I haven't, please send me a question. I love doing these videos. This one was a really long one. I usually do short 3-minute videos, and I'm happy to cover questions that you have in short 3-minute videos. Would love ideas on the content. Please reach out to us anytime. We look forward to hearing from you.